Let's look at inflation. We're nearing record high inflation, and it seems to be heading higher. You've been a contrarian on the subject, saying that we are actually headed for deflation. Are you still thinking this way?
My view is that what we're going to do here, as the fundamentals reassert themselves, that we will see deflation in the durable goods, significant deflation in the big ticket items, service prices, which are influenced by a lot of rigidities in government regulation and so forth. Those prices will continue to rise, but there will be disinflation as we proceed forward.
When will that be? Meaning, we've had you on before, kind of the Fed has said these COVID kind of supply chain issues could last another year to 18 months. When do we see deflation? I mean, I know that's a hard guess.
Timing is something that we don't really try to do at Hoisington Management. We take a big picture strategic view. We want to be positioned. One of the real problems for the Federal Reserve is that last year, when inflation moved above their target band, they didn't do anything about it. And they have a dual mandate. They have both the labor markets and inflation. And so they let inflation develop a momentum, and they now have to reverse that. There's a couple of things about that. The inflation is having a devastatingly negative impact on the budgets of a lot of people. We have about 77 million people that receive weekly paychecks. And in the 12 months ending January of this year, inflation has outstripped wages by 2.5%. That's the 12-month decline since July of 2008, when we were in the recession associated with the Great Financial Crisis. And in addition to the 77 million people that receive weekly paychecks, we have probably another 30 million people that are receiving biweekly checks, but they're in the same pay range as those with weekly. 86% of our people earn less than $150,000. And so, and then we have 20 or 30 million people that are retired, and their income is rising hardly at all, and they have to face this 7.5% inflation rate. And so it's having a devastating impact on family budgets. And modest and moderate income households are being hit very hard. And when you create this situation, you do a lot of damage. So last year we had 6.6 million new jobs. That's a good thing. But we severely damaged the budgets of more than 100 million people. Trade-off was terrible. And so now the Fed is belatedly moving to control the situation. But this is not a skill that they've shown to possess in the past. If you look at Federal Reserve periods of restraint since the Fed was founded in 1913, they've been successful in engineering a soft landing only about 10% of the time. So they are moving against it, moving at a snail's pace, but in the meantime, they're leaving a huge proportion of the American household in extreme distress. And in the meantime, there's still upward pressure in certain items, food, fuel, and rent. All of these are what we call price inelastic goods. We don't have good substitutes for them. And so the inflationary process is a cyclical negative. The Fed has to do what they are going to do, but they've allowed themselves to get behind the eight ball. Another element that's in the picture, and I think will help to eventually unwind the inflationary process, is what's going on with inventories. When the pandemic hit, the key phrase that referred to inventory policy was just in time. It was a very bad situation to be operating under such a situation. The supply side disruptions came in, and inventories couldn't be delivered. But what is taking place right now is that there is a massive shift to what I would call just in case inventory policies. In the second half of last year, in the face of this stiff inflation, the growth in the economy, excluding inventories, was only 1% annual rate. The rest was contributed by inventories. And inventories will add a little bit more, but I think that a lot of firms are soon going to find out that they have too much stuff. And there's more goods coming in from China and around the rest of the world. There have been bottlenecks in the ports, but the president of one of the big shipping lines said that the international freight rates are falling. The dry freight index, measured by Baltic, is down 75%. The number of ships waiting to unload off the coast of California is coming down. And I suspect that there was double and triple ordering by frustrated people. And so the process is going to unwind due to the three forces: the damaging impact on the well-being of our households, the bad situation that the inventories were in, and then also the restraint of the Federal Reserve. But the notion that the economy will have a weak first quarter and do better, in my view, is quite misplaced. The economy is going to have great difficulty, and there's one other element that I'm keeping my eye on here, or a couple of other monetary elements. Since mid-December, the Federal Reserve has reduced the total reserves of the depository institutions by more than 10%. And the other deposits, which is the key component of M2, is now growing at only about a 1% annual rate, at 13% last year. And the decline in velocity that we've been experiencing, since the late 1990s, in my view, is going to continue. And so the monetary process is going to intensify. And I think that there is some confirmation that my view is going to be correct. A very prescient indicator is the shape of the yield curve. In other words, the spread between the short intermediate rates and the long rates. And as the Fed moved to end tapering in mid-November, we've seen the short intermediate rates rise very rapidly, and the yield curve is flattening. That yield compression tends to reduce the profitability of the banks and the financial institutions, but it's also a sign that investors believe that the inflation rate and the real growth rate will come down as we move forward, and that's certainly my view.